Hey everyone, welcome back to Unfoolish Investing. Today I am flying solo because Larry is off in Sin City, probably discovering a whole new financial journey of his own. Who knows? Maybe he's studying the economics of blackjack or investing in some slot machines. Either way, I've got you covered while Larry explores his Vegas strategy. So let's dive into something a little less flashy today but way more important for your wallet: tariffs and how they impact your investments. So let's start with the basics, shall we? Tariffs are essentially taxes placed on imported goods by government. They're meant to protect domestic industries by making foreign products more expensive. The idea is that if imported goods cost more, consumers will prefer to buy homegrown alternatives. That's right, things made and built in the United States. It sounds simple, right? But tariffs have far more reaching consequences that ripple through our entire economy. So, where do they go? Well, how do tariffs affect the economy? When a tariff is placed on goods from another country, say like an iPhone, it can trigger a chain reaction. The price of imported goods goes up for that item, which leads to higher costs for businesses that rely on those imports. In turn, businesses may pass those costs on to consumers through higher prices. That's right. The country that is making it and bringing it in, they're not the ones that are paying the tariff. The company bringing the item in pays the tariff, and then they have to determine how much of that do we pass on to the consumer. So if that tariff for the iPhone is $200, do I pass the full $200 on to the consumer? Maybe I split it and it's only $100. Maybe it's a little less, or maybe I just put the whole $200 onto you. But it's not actually the country that's sending it in that's paying the tariff. And with higher prices, well, that contributes to inflation, reduced consumer spending, and a slowdown to economic growth. Sound familiar? All factors that affect the stock market. Now, not all industries are affected by tariffs equally. For example, manufacturing and technology sectors that rely heavily on importing components are hit the hardest. I think we just talked a little bit about iPhones. Think about companies that make cars or electronics. They often depend on parts made overseas. Higher costs from tariffs could mean lower profits and, in turn, a drop in stock prices. On the other hand, domestic producers of goods that compete with imports could benefit from less competition, boosting their stock value. Now, how do tariffs influence, the global world? Well, because they don't just affect the economy, they also impact international relations. Think of countries that are often relatively imposing their own tariffs on exports, like China. And that starts a trade war. This can create a negative feedback loop, escalating into full-blown trade war, like what we saw between, as I just mentioned, the US and China in the last few years. Trade wars lead to uncertainty in global markets. And as any seasoned investor, unfoolish investor, knows, uncertainty is the enemy of stability in the stock market. So, how do tariffs affect your investment strategy? Well, if tariffs are likely to hit certain sectors, you might want to reconsider investing heavily in those industries. For example, during the US-China trade war, tech stocks that relied on Chinese manufacturing were particularly volatile. You also saw companies like Apple start leaving China to go manufacture in other countries, trying to offset some of that. Diversification is key here. By spreading around your unfoolish investments across different sectors that we keep on talking about, you can protect your portfolio from the risks associated with tariffs. Now, let's talk about the unfoolish investor, because we're long term, right? Tariffs might create short term market volatility, which you're investing for the long haul, though. That's what an unfoolish investor does. You might not need to worry as much. The market often corrects itself over time. And as we like to say in unfoolish investing, it's not timing the market, it's time in the market. What's important is to stay calm during these periods of tariff-induced turbulence. Don't buy into the media frenzy or the panic selling. Look at it as an opportunity to buy stocks at lower prices if you believe in the company's long-term fundamentals. And that's what we try and push here at Unfoolish Investing. Solid companies with long-term fundamentals that we believe in. Now, let's look at the real-world example, shall we? The steel tariffs. We keep on hearing about the steel tariffs. The steel tariffs introduced by the Trump administration in 2018, U.S. steel producers benefited as foreign steel became more expensive. But industries like construction and automotive, which use a lot of steel, saw costs rise. They didn't go down. Stocks in these sectors reacted accordingly. U.S. steel stock spiked, while car manufacturers saw their profits squeezed. This illustrates just how tariffs can be a double-edged sword for investors, especially if you're invested over here in the steel market and over here in the car market. It's important to note that tariffs aren't always bad news, though, for investors. Sometimes they can create opportunities. For example, if a tariff hurts a foreign competitor, a domestic company may see increased demand and revenue, which could drive up its stock price. However, predicting which industries or companies will benefit from tariffs requires research, and that's what our well-diversified portfolio comes in handy. And that's why we always talk about at Unfoolish Investing, keeping that well-diversified portfolio. Politics play a big role in tariff policy, and political shifts can lead to changes in tariffs. Elections, trade negotiations, and diplomatic relations can all influence whether tariffs are imposed, lifted, or increased. Investors need to stay informed about these developments, anticipate market reactions, and that's what Unfoolish Investing is here for. We're here to make sure you stay up to date because we're doing the research for you. We're keeping an eye on those trade policies to make sure that it's crucial when making informed investment decisions. To wrap things up today, tariffs are a tool used by governments that can have significant effects on the stock market. While they can protect domestic industries, they can also introduce risks for certain sectors. As unfoolish investors, the best approach is to stay informed, diversify your portfolio, and take a long-term view when the market experiences tariff-related volatility. Thanks for tuning in to Unfoolish Investing. If you found this episode helpful, make sure you like it, subscribe, and share. Stay smart, stay calm, and keep investing the unfoolish way. Till next time, let's hope Larry makes it back from Vegas. We'll see you then.